Welcome to this podcast where I'm going to be looking at what we do if we're going to use a cash flow statement to make some analysis of a company. Okay, first thing to stress is, because particularly if students are doing business studies, sometimes business studies we use cash flow and cash budgets sort of interchangeably. They are completely different. A cash budget is something that is forward-looking. It's used by companies to try and plan what they are going to do in the future. It's based on estimates, and indeed a cash budget in most businesses, certainly the businesses I worked in before I came into teaching, those cash budgets were subject to revision during the course of the year. It's not a legal requirement, although to be honest, in all businesses, it's a necessity to plan what you are going to do with cash. Cash is a precious resource for a business. They need to use it wisely and they need to make sure they have enough of it. And a cash budget is purely a management tool. You may show it to the banks, for example, to get a loan. If you're doing a share issue, you may have a projected cash flow, but fundamentally it's something that's designed for use by managers to manage a business effectively. Cash flow statements, as those of you that have already studied it, is completely different. It's retrospective, which is a posh word that means it's looking at what's happened in the past or historically. It explains to outside people from the company, so the general stakeholders, why it is that the change in profit and the change in the amount of cash, for example, has occurred. So it's not unusual for a business to go from having a positive amount of cash to having an overdraft in a year, but also having at the same time a significant profit. And investors need to understand why that has occurred. It's a legal requirement for limited companies. So whether they want to do it or not, and whether they manage the business efficiently or not, they need to do it. And it's much more focused on stakeholders in general, and obviously quite specifically shareholders as well, because they need to understand whether they want to continue investing in a particular company. Okay, just because during the series of videos I've been producing, I've used the same mark scheme for an exam to demonstrate a cash flow statement. But I think the important things about it are, first of all, cash flow statements are objective. And by that, it demonstrably follows the money measurement concept. It's all about money and where money's come from and where it's gone to. And that makes it a very objective way of looking at a company. It's not subject to any of those potential window dressings that businesses can do. A manager cannot manipulate the amount of cash generated and used, because ultimately, at the bottom of the cash flow statement, and you can also find this information in the balance sheet, the amount of cash at the start of the year and the amount of cash a business has at the end of the year are both measurable. And therefore, things like altering provisions or other accounting policies by the management of the company will have impact on profit and profitability, but they will not have an impact on liquidity and the amount of cash in a business. Right, when we're looking at a cash flow statement, there's obviously the three main sections. Although I would talk about the other two sections afterwards and argue that they are quite linked together. Okay, but the operating section is obviously very, very important. As with liquidity versus profitability, long term, if a business isn't profitable, it will not generate the cash to survive. There are ways to get around the problem in the short term if there's a particular problem in a short period of time, but ultimately profit is important, and ultimately for cash flow, being able to generate profit from the operations is absolutely absolutely clear. So this figure, the operating cash flow before the working capital changes, is important because that's saying on a day-to-day basis how much cash a business is generating over the course of a 12-month period. And this business has done quite well, it would appear. They've generated £1,363,100 worth of cash. So depending on the size of the business, that would probably be quite significant, and that is important. Okay, these short-term changes, the operating cash flow before working capital changes, they are going to help me to measure how efficiently the business is managing its cash on a day-to-day basis. But I need to be careful when looking at these inflows and outflows about sustainability in the long term. So, for example, this business has decreased its inventories. Now, it's right, and businesses should be using cash wisely, and they should be keeping the minimum optimal holding of inventory. Okay, but that might not be something that is sustainable in the long term, because at some point your inventory holdings become that small that you are not able to always supply your customers. So these are important indicators of the efficiency of the management, but be careful when interpreting a situation where the operating cash flow before working capital changes is negative and then becomes positive because of the changes on all the current asset and current liability positions. Okay, how sustainable are they? And this cash generated from operations, it's important to look at because a company has to meet certain obligations from this cash really in the long term. It's got to be able to pay the interest that it has to pay because they are creditors of the business. If they don't get paid the interest, if it isn't generating the cash to pay that interest, the business is going to have a real problem. And also, has it got the cash? Is it generating the cash to pay the tax? And what I would also look at if I'm looking at my investments, I would also make sure that this cash generated from operations isn't just going to be able to fund the tax that's being paid, but I would also look at the tax on the statement of financial position for the current year and make sure that they've generated sufficient sufficient cash to pay the tax that they now owe as well for this year. And the final thing as well, really, I've pulled this out of the financing section, but sustainability of the dividends that have actually been paid is also linked to this number, the cash generated from the operations, and also the net cash from the operating activities after we've paid the interest and the tax. So and here it's quite healthy, this company has paid 109,600 out in dividends. Okay, but the cash they generated from day-to-day operations was 1,223,600. So you feel fairly confident this company is successful enough at creating tax to at least maintain the current dividends they are paying. Okay, now to have a look at the investment financing activities and what we can get. And I'll look both what we can get specifically from a cash flow statement and then also just talk very briefly about the fact that there are many things that you can see from a cash flow statement you can also get elsewhere from elsewhere in the accounts. Okay, so obviously, one of the first things I would have looked at from the cash flow statement anyway is what's happened to the amount of cash, because that's important for me as an investor. And in this case, the business has got a positive amount of cash at the start of the year, and they've then got a positive amount of cash from the end of the year. One of the objectives that businesses try to kind of meet is they try to match the length of funding, so how long a loan is, with the length of time that they are expecting to use assets for. So what I would expect is some kind of correlation between the loans coming into a business or the shares, the new shares that have been sold, and therefore generating funds for a business, and the asset purchases. Some of that funding can come from the cash generated from operations, but there's a clear link in these two activities. And here, ultimately, overall, the company has invested 955,000 in long-term assets they're going to generate profits from, and then use those profits in part to repay the loans business has got, and also to pay interest and pay the shareholders a dividend. So here there is a bit of a match between it, because they've spent 955,000 of the bank loan on the purchase of tangible non-current assets. So I'd expect some kind of correlation there. Where there might be a little bit of an issue here is there's been a significant outflow both in redeeming the debentures and in redeeming shares. And there might be some question here as to whether this redemption of shares is justified at the moment. I think probably it is, because they haven't paid a lot of dividends, but they've generated a lot of cash from operations, so they're finding a way to get the money back to the shareholders. But I would look at what's going on here just to make sure that I'm comfortable with it. So overall for this business, then you'd have to say overall there's been a net increase in the amount of cash and cash equivalents in the business. If I was an investor, certainly I'd be quite happy. They found a way of getting some money back to me over and above the dividends that I would have expected in the normal state of affairs. And I'm confident that this amount of cash they're saying they've generated is going to be true, because I know what the year end and the start of the year cash positions were. There are other things that you can see in general from the cash flow statement, but they're not specific to the cash flow statements. That's things like many things that you can see from both the income statement or the statement of financial position. So I have got a sense here for what's happened in, for example, the non-current assets of the business, and the fact there has been some significant investment. And it would also appear that they have, for some reason, had a significant sale of some non-current assets. I don't know why that is, but I would go off and look for that somewhere else. And the other thing here that I can see, but I could also see this from the statement of change in equity, there will have been a change in the capital structure of this business, because the amount of owner equity has fallen, okay, but the amount of debt capital has increased by 500,000. So that's something that I can see from here. One final point, particularly as this is aimed at my A2 students, when you're looking at analysing any financial information, I think it's important to look at the context of what's happening. So, for example, if we look at ratios, if a company I invested in had got a current ratio of 5:1, I would immediately start to question how well that business is managing cash, because they've got a lot of near cash non-current current assets for a very small number of current liabilities. Now, it doesn't mean the business is wrong. It means that that's something I, as an investor, would think, well, is something wrong in this business? And I would look for information on the internet and in the accounts of a business. And if, for example, I was then aware that this business was just about to take over another company and it was an all cash purchase, then I would be expecting them to have in some way generated a lot of cash so that they could make the purchase. So, as with the comments we've made on the cash flow statement, there are things that we are looking at, but we also need to look at the context or the background to why those changes may have happened, before we are fully confident they are a good thing or a bad thing. Right, just to wrap it all up, and because it's something you might need to write about in an essay as well, how useful is the cash flow statement? We've linked to the advantages already of it, the fact that it follows money measurement, the fact that we can't window dress it. And I think the big criticism I've got is it's a bit difficult to understand. If you've got no finance background, understanding what's on the left of your screen is quite a difficult thing to do. And it also shares many of the same criticisms of all of the final accounts. So things like it is retrospective, and it only presents a small part of the picture of how a business is performing, or more accurately has been performing. So we need to look at a whole range of things, and it's work at getting the information from the company, the information that you can see online, the information contained in all the financial statements and the notes together, that we can fully build up an accurate picture of the business. It isn't in its own right something that will solve all of the stakeholders' questions and problems within a business. Right, I hope that this helps. And obviously, the students I teach, please email me if you've got any questions. Thank you. Bye-bye.